Hi, Charles Sizemore here. Today we're going to talk about one of my very favorite corners of the income market, closed-end funds, also called CEFs for short. So to describe how these things work, I think it's probably easiest to start with how they don't work. Let's compare them to your typical mutual fund. What you think of as your standard mutual fund, the sort of thing you would own in your 401k plan. So the way a mutual fund works is when you want to invest, you send the manager money. They take that money, they deposit it, they use it to buy stocks, bonds, whatever. When you want your money back, when you're ready to sell the investment, move on, they sell off a small part of their portfolio, and then they send you the proceeds. Now, obviously, if you're doing this through your 401k plan, you don't actually see this. It all happens behind the scenes, but that's how it works. There's always new money going in. There's always money going out. That's how a mutual fund is organized. Now, with a closed-end fund, it's not like that at all. The fund is like a stock. It has an initial public offering. It goes public on the New York Stock Exchange. And if you want to buy shares, you just buy those shares on the New York Stock Exchange. It's fixed, like the number of shares are fixed. There's no new money going into the fund. There's no money coming out. There's a finite number of shares. Now, that's similar to an ETF, but it's also different. An ETF, an exchange-traded fund, also trades on the New York Stock Exchange. But with an exchange-traded fund, you actually can create or destroy shares. Well, you and I can't, but large institutional investors can create new shares or destroy existing shares as market conditions dictate. Now, why would they do that? So let's imagine you get a situation where an ETF is worth more dead than alive. The market price of the ETF is $8 a share, but the value of its portfolio is $10 a share. Well, a big institutional investor could buy up as many shares as he can afford at $8 a share, break them open, take $10 worth of underlying stocks and bonds out of it, and then sell those and then walk away with a $2 profit. That's how ETFs work. The idea is that mechanism, that arbitrage mechanism there, forces the ETF prices to be pretty close to the net asset value. They can deviate, but not much. With a closed-end fund, totally different. There is no mechanism for creating or destroying shares generally. So you can get wild variations in price where these things trade at either large discounts or large premiums to their net asset value. So I have no interest in these when they're trading at a premium. Why would you ever pay $1.05 or $1.10 or whatever for a dollar's worth of assets? That makes no sense whatsoever to me. But when they trade at a discount, that's when I get interested. So the typical closed-end fund will trade at a slight discount to net asset value. Like that's the normal state of affairs for those. But where they get interesting is when they trade at a deeper than usual discount. If something happens in the market, there's a sell-off, some large investor sold and pushed the price down. There can be various reasons for it to happen. But periodically, these things will just sell off and the market price will be substantially less than the value of its underlying stocks and bonds. Sometimes that discount is 10% or 15% or even more. That's where it gets fun. So, let's look at how you profit from these things. The most obvious, there's three ways, but the most obvious is the dividend yield. These tend to be high yielding investments. Closed-end funds tend to buy stocks, preferred stock, dividend paying common stocks, whatever. They buy things that tend to throw off a lot of income. And then the fund itself borrows a little money to juice the returns, allowing them to pay out very, very hefty payouts. Typical dividend on these things might be 5% for a municipal bond fund, might be 8 or 10% for a more aggressive taxable bond fund or preferred stock fund or what have you. So that's the most obvious way to profit. Secondly, these things are actively managed. The managers buy and sell the stocks and bonds in the portfolio, trying to eke out gains along the way. You can get, a couple percent of returns in capital gains as well. If it's a more aggressive stock fund, it could be a lot more than that. But that's a second source of return, the increase in value of the underlying portfolio. But the third part is my favorite because this is where you can really throw gasoline on the fire and watch it go boom. When these are trading at a deeper than usual discount, let's say a typical discount might be, let's just make up a number, 5%. but for whatever reason, these funds are trading at a 15% discount to net asset value. Well, if you buy it at that discount and just be patient and wait for the share price to rise to meet its typical discount, go from a 15% discount to just a 5% discount. Well, that's an extra 10% of gain. And moves like that can happen very quickly. They can happen in weeks. They could, it may take a year, who knows? But they can happen pretty quickly. So while you're collecting that usually monthly dividend, while you're waiting, while you're allowing the portfolio itself to increase in value, you can also wait and allow that larger than usual discount to close. That's fantastic. These are, generally speaking, pretty boring conservative investments. But if you buy them here at the right time, when they're trading at a deep discount, they can go from being a boring investment to something that'll generate 20 or 30% in a year. That's not always the case, of course. You have to really wait for those great windows of opportunity to open. But we had one of those windows, I think, back in the fourth quarter of last year. That's when I started really loading up on these in peak income. Now, it's interesting. Over the course of 2018, I actually unloaded most of my closed-end funds because the pricing wasn't good for them. The market turbulence wasn't good. A lot of the deep discounts I had seen in previous years had closed, and it just wasn't a good time to be in them. But what we saw in the fourth quarter was when the market sold off, a lot of investors just dumped these closed-end funds. Those discounts to NAV shot higher. That created a very, very nice entry point for us. So in December and January, we added 6 new positions in closed-end funds. Will we add more going forward? Well, we'll see. That's going to depend on what happens in the market. But when you see opportunities like this pop up, when you see those discounts get really wide, that's when you need to strike. And that's exactly what we did in peak income.